Well, thank you everybody for joining us today, and thank you to the host for putting on this event. So, kind of getting to it, I'm sure most people probably think that hedge funds are not really super involved in the tokenization field and space. It's actually changing quite a bit, and that's going to be the genesis of the conversation for today. So just to get right to it, let's actually start with you, Sanat. I want to understand from your perspective as you run a hedge fund, what are hedge funds looking for right now when it comes to tokenization?
Yeah, so good morning, guys. So I'm the CIO of Monarq Asset Management. So we have two large hedge funds, a Bitcoin-denominated market-neutral fund and a USD-denominated market-neutral fund. And so because we are market-neutral, we're all about yield, right? And so when we look at the RWA ecosystem, we're looking at, there's four criteria that we look for. The first one is just what's the yield of the underlying asset. The second one is what risk are we taking on as a firm? So what does the underlying asset invest in? The third one is it composable? Can I deposit that in another DeFi protocol, borrow USDC, USDT against it? Can I loop it? And then I think the fourth one is the liquidity, right? How quickly can I enter and exit this? And it's very interesting. So for us, RWAs are, it's a brand new category. It's a new uncorrelated area for yield. And I'll just give a quick example. So the Apollo ACRED X, which I believe is actually going to be launched on Centrifuge today, I just use that as an example. So this is the Apollo Diversified Credit Fund, right? Just an outstanding product yielding 8-9% annualized. And this is a great product for us because it's a very different kind of yield than what we normally get. Normally we are DeFi yield farming and point farming and doing the cash and carry arbitrage. This gives us real world yield, right? This is giving us yield from corporate finance, from asset-backed securities. And so that's something that's actually very interesting to us. It's orthogonal. It's just great from a risk management perspective. So yes, I think the yield's great. The underlying risk is great. I'm sure that at some point we'll be able to loop it, right? We will be able to deposit the ACRED X token on Morpho or Euler, and then be able to loop that, and then that's going to be important for us. And then the liquidity, that's something that's the one challenge for real-world assets, that they're not as liquid as they are in DeFi, right? So the traditional DeFi asset, I can get in and out instantaneously, whereas a typical private credit product, in the real world, usually you only have quarterly liquidity, right? And so obviously with something like an ACRED X, we'll have to see what that looks like. And usually there will be someone else, like a market maker, who takes on the liquidity and provides us with the liquidity for a fee. So long story short, super excited about RWAs. We've already allocated into this space as a hedge fund, earning yield. And we do everything from T-bills to private credit. Haven't yet done the emerging market debt stuff, but that's coming as well.
Great, thank you.
Yeah.
So at Crypto Insights Group, we run monthly surveys with a few hundred crypto managers of all types, liquid managers, and large asset allocators. And in last month's survey, we actually asked a particular question that was quite interesting, which is about funds generally tokenizing, whether hedge funds or VC funds, and then traditional funds that are looking into the space, just as you mentioned too. So Kevin, I'm going to direct the next question to you in terms of what you guys are doing at Grove, but what are you seeing in this space right now? And I guess from the perspective of a fund manager considering tokenization for the product, tell us some pros and cons that an investment manager may want to consider.
Yeah, definitely. So for context, I'm co-founder of Grove Labs. We're one of the largest capital allocators from DeFi to TradFi, and we acquire at scale tokenized assets. We currently hold about $770 million in Janus's JAAA tokenized product. So when we look at like a tokenized fund like the JAAA product, one thing is, from our perspective, the on-chain ecosystem hasn't been able to access assets like AAA CLOs. So the very first question is it's a net new distribution channel when asset managers are tokenizing their funds. It's new sources of capital, new LPs, new ways to get their product out into the world, of which we're generally the first allocator at scale, but a lot of other on-chain treasuries and organizations and distribution channels open up once you sort of build that liquidity on key networks. The other side of the equation is we see a lot of tokenization of fund vehicles in order to improve the liquidity for the traditional investor set. So to be able to tokenize your fund product and then have that be accepted as collateral in markets like Morpho, where once again, Stakehouse, another organization that I'm a part of, or one of the largest risk curators on Morpho, that ability to get your collateral accepted into these repo markets where traditional holders can then acquire stablecoin liquidity against that on a fairly short duration basis. It is quite attractive and a great feature to have to improve basically the liquidity profile and the offering of your traditional fund. Hopefully that.
So, and by the way, I think Kevin's being modest. He's the biggest allocator of capital in the DeFi RWA ecosystem today, right? Much bigger than us. So, yeah.
We're trying to allocate some more, but I appreciate that.
So I generally don't like to do this to people on the spot, but I'm going to do it anyway because I like you. Let's take out your crystal ball. In terms of the potential collateralization for what you're seeing over, let's say, the next 6 to 12 months, how does that look?
Yeah. I think as we see more of the rate environment decrease, we'll probably see higher yielding, tokenized private credit or tokenized alternative assets fund vehicles be pushed on chain. And the real reason for that is, at the end of the day, the base rate of borrowing across all of DeFi is sort of set against lending against Bitcoin, which is around 5-6%. So it's really not attractive if you're holding USDC to lend to something that is yielding less than that, i.e. treasuries or even potentially CLOs as we move into a lower rate environment. So how do we get to those higher rates? Well, obviously there are assets out there and that can provide that profile with the exception of some longer duration or some additional concessions that have to be made on the lender side. So that's something that we're actively investigating and working with great partners. A little bit of alpha here. We're about to announce today our allocation of $50 million into Apollo's ACRED vehicle. So very excited. We're going to do that on Plume. So that's, again, just one of the ways that we're shifting towards dealing with this kind of potentially lower rate environment.
Great. Wow, we have 2 announcements today. Will, any announcements you have for us?
No announcements from me. Just continue to do the same thing.
You always have so many announcements.
So, maybe just a quick intro on myself. I co-lead the venture team at Galaxy. I'm also deeply involved in our DeFi capital allocation strategies. It's not formally a hedge fund yet, but it's sort of, we're headed in that direction. We're very focused on allocating money into different DeFi protocols, which includes RWA allocation, and so we do kind of deep diligence on, RWA protocols broadly. I mean, I think I agree with everything these guys say. I think, the biggest points are liquidity. Composability is really a property that we care a lot about when it comes to on-chain assets. I think the trick has been historically, if you're dealing with securities on-chain, to what degree can you actually compose them with other parts of DeFi and use DeFi for capital formation? I'd say like the biggest trend that we're paying attention to, which I think the audience, might be interested in, is like, there's essentially 2 strands that I see going on in tokenization of funds right now. One is the actual tokenization of the fund interests, which a lot of people have been trying, for a while. And then like that's ACRED, that's the Janus Henderson fund. That's many other funds, and it's definitely been done, and using on-chain as a capital formation mechanism. The other approach, which I think in some ways was pioneered by Athena, starting in 2023 and 2024. Maybe there's origins before that, but it's really this concept of vaults. And I hear at least our community talking about sort of tokenized funds and then vaults as sort of like 2 branches of the same tree. And really what Athena and some of these strategies represent is the allocation of capital to a manager or curator who's going to run a strategy on your behalf in a dollar-denominated fashion. In a lot of ways, that looks like asset management or hedge funds, but they have, they're not really treated as like full funds. They're kind of running a programmatic strategy under the hood to earn yield. It's a synthetic dollar or a yielding dollar, and those products, have retained full composability, and you can see just what products like Athena and others have accomplished. There's another product called Re.xyz, which has a reinsurance product, and you can see what those have accomplished in terms of capital formation by getting their sort of roots spread broadly out in DeFi. And so those retain some advantages, I think, over like pure fund interest tokenization. And that's an exciting, I'd say, division that I'm, paying close attention to, and we're paying close attention to, is how the two paths either converge or diverge from here.
So for me, being a head of a due diligence now and formerly head of due diligence at Bitwise, what's near and dear to my heart is due diligence on these things, whether it's the actual token itself from a infrastructure technical perspective, or you mentioned vaults as well too, with the curators. I'm curious, Will, I'll start with you and then Kevin. How do you guys view due diligence either from a technical perspective or even kind of a qualitative perspective with some of these organizations out there? What are maybe some pointers that some could consider around here?
I mean, I think it's undeniable that on-chain the threat matrix or the risk profile changes versus an off-chain asset. I mean, all of the risks of an off-chain asset, insofar as you're putting an off-chain asset on-chain, are retained. But then you have the other crucial issue of security. And security, when it comes to DeFi capital allocation, is like our most primary focus, right? Where if you do the calculation, and we've done them recently on, your expected losses from interacting in DeFi, the number one contributor to your expected losses or your probability of default is going to be, security risk, hacks, et cetera, for the last 5 years in DeFi. And so you have to work to very actively mitigate that. That's audits, on the underlying protocols. That's security monitoring sort of in place and in situ. So those are, I'd say we spend 80% of our time on security due diligence when we're allocating to tokenized assets, allocating on-chain broadly. Obviously, with tokenized assets, there's a broader set of criteria, including, what's my actual level of legal ownership, right? If this asset is brought through bankruptcy, am I the owner or is somebody else the owner?
Right.
Which is actually a very crucial question for tokenized assets. I don't know. You guys probably have a perspective on what other types of due diligence you do on tokenized asset before you allocate to them.
Yeah, Sanat, you first, and then we'll go to Kevin.
Yeah. So it's a great question, right? And I agree with Will that when something is on-chain, it's an off-chain asset that's on-chain, you're taking on both the risks, right? So you have the traditional risk of a lending of private credit, defaults, et cetera, off-chain, and then you also have the on-chain risks of hacking and being rug pulled and all the stuff that we see in DeFi. And so for us, the way a hedge fund would look at this is that you then end up having you have sizes, right? You say, okay, I'm only going to deploy X percentage into each of these protocols. And the other thing that you do is that you're then saying, okay, I need the yield needs to compensate for the risk, right? And which is why what ends up happening for us is we end up looking at real world assets, and almost always we are looking to loop it, right? So and I know it's not a security question. So in fact, we're actually adding more risk, right? But we like to loop it so that the yield is higher than what it would be traditionally in just from the asset itself, right? So and looping means basically depositing, rehypothecating the asset, depositing that somewhere, borrowing USDC against it, and buying more of the same asset, and so on. And so for us, I guess the best way to say it is because I'm adding on more risks, I need the yield to be higher, right? And that's what we're compensated for that, and that's why we loop it.
Understood. Kevin, your thoughts?
Yeah. I mean, like summarizing Will and Sanat's thoughts, we think about it in the ways of what are the off-chain risks, what are the on-chain risks. We further segregate it to say, all right, what are we underwriting in terms of the asset, the credit quality of the asset, the security, and all the associated risks that we're taking on there. The legal structure, which is generally has been quite standardized, and I think this is one thing that's really empowering this space, which is, for example, with centrifuges, anemoid structure. We're seeing that be very repeatable, and as you get more fund structures kind of tokenized in a similar setup, it adds to the diligence. It adds to the basically network effects that you get there. And then as a native on-chain capital allocator, we take smart contract risk and on-chain risk quite seriously. We require 2 audits for every single smart contract that we interact with, a ton of Lindy, and we have a ramp-up period for new protocols. So the diligence is quite strong. However, I would say one of the unique aspects of interacting with RWAs, and this is something that we are hoping to release in a blog post later, is sort of when you're underwriting the technical risks of an RWA, it actually, in many cases, the smart contract risk is significantly lower than dealing with a purely immutable, purely on-chain crypto-native DeFi protocol. Why? Because of the finality aspect of, if I lose my Pendle tokens, I lost my Pendle tokens. Like they're gone, they're with probably North Korea. But in the case of a tokenized RWA, if I lose my shares in JAAA, which we hold a lot of, I have a legal guarantee to the fund administrator, which is a licensed fund administrator, right? The whole operating structure that is a centralized entity, which is to the dismay of many on-chain communities, but it gives me that guarantee that I can get my shares back. And
it's not purely decentralized.
Exactly.
Right. So it is.
And that actually reduces this on-chain technical risk and the smart contract risk significantly. So yeah, we apply that lens with everything that we underwrite, but we always kind of follow a similar, I think, path to get there. Yeah.
For those of you keeping score, Kevin just stuck in a second announcement about his white paper coming
Making
out.
a lot of commitments.
So there we go. All right. I want to take a step back, and I'll describe it more as a kind of a macro type of question, but not macroeconomic, macro in terms of infrastructure environment related to tokenization, RWAs. And Will, I'm going to direct this one to you too. So again, just going based on our research, it seems that as of right now, if Ethereum is really the preferred rail for tokenization, but obviously, we have Solana, there's other ones out there too. Just maybe take a few minutes just to talk about your views on that. Is that going to be the long-term, preference for organizations that are tokenizing assets, or are there other things on the horizon that everyone should be considering?
Yeah, it's a good question. I mean, so in my responsibilities kind of leading ventures, I focus a lot on protocols in particular at Galaxy, and we're very much like oriented vertically, right? So we're thinking about the financial application stack as we invest in the protocols. So it's not just kind of in a vacuum. It's what features at the base layer of the protocols are going to be most impactful for the application layer in terms of financial services. So it's a question we deal with often. I'd put it in a couple different categories. Like a couple different criteria. I think Ethereum has this really strong built-in network effect that already exists. I mean, if you just, and not to harp on Athena again, obviously it's a portfolio company of ours, but I think they've done really spectacular things. If you treat them like an asset manager, which I think they have qualities like an asset manager, I'm not saying they are an asset manager, they would be the fastest asset manager ever to 10 billion in AUM. They did it in about 18 months. That happens because they leverage the capital formation and the network effect that's already present on Ethereum, right? So Ethereum has this, like, if you want to bootstrap an asset and bootstrap a tokenized asset or a tokenized adjacent asset, Ethereum is absolutely the best place to do it because of the network effects you get around Pendle, around Aave, around Uniswap, and all of the integrations Ethereum already has with exchanges in the broad ecosystem. That said, if you look at Galaxy's tokenization of our shares, which was announced last week or the week before, with Superstate, that was done on Solana. And one of the reasons it was done on Solana is because Solana is ultimately faster, it settles faster. So if you have the expectation that there might be markets in the future, 400 millisecond block times are far superior to 12-second block times, just because of the speed at which market makers and sort of institutional traders could update their prices. So Solana looks really good in the kind of trading context and trading capacity. Then you have sort of new age chains like Plume, which Kevin mentioned, which are layer 2, or Plume's a layer 1, but they're focused with a kind of business development or application-specific target around real world assets. And so there, when you deploy on Plume, you know that the team there and the ecosystem is going to be broadly built around the development and the expansion of RWAs or tokenized assets. And so you can have confidence as that as a business development kind of lever. And then you've got sort of new age blockchains, Monad, which is launching soon, and is certainly going to have some of the performance qualities of Solana with some of the EVM sort of network effects of Ethereum that could be quite interesting. So, that would be my landscape before. You've got the Ethereum L2s. The SEC hasn't made any super clear comments on this, but they've come out and made some interesting comments that the sequencers on L2s potentially look like look like they should be registered ATSs because it's single sequencers that would be basically transacting in securities, and so there's some threshold questions of decentralization that I know Hester Peirce is focused on. So I don't know if you guys have any further thoughts on the ecosystems and the underlying protocols, but
I think the only thing I would add there is. There's always the question of how can we kind of break the barrier of getting broader access to these assets, right? And I think we've seen a couple what is deemed permissionless, like types of structures arise, and I think that trend will continue because there's just so much demand for these assets, and it's not just within the U.S. and a lot of these structures, mainly also pioneered by Robinhood as well, are, providing through these new mechanisms, providing the access to these assets to broader markets through these sort of more permissionless structures. And I think we'll see a lot of adoption there.
Yeah, and I think for us as a asset allocator, the composability is very important. Mm-hmm. And on Ethereum, I think as Kevin and Will said, just the ability for us to go create a PT version or a YT version of this token, or buy the PT version, or deposit an RWA token onto Morpho and borrow against it, those things become so important for us, which is why I think, and I'm sure that those are available on the Solana side as well, but just at scale, when you want to deposit millions of dollars, today all of that is on Ethereum, right? All of that, the liquidity is on Ethereum.
Yeah.
So listen, we only have a few minutes left. I want to ask, I think, an important question for many here, which is kind of like the LP perspective of things. I'm not going to start with you because I know you have a very strong position on this, i.e. your business. So Sanat, I'll go to you, running a fund. Are LPs knocking on the door to have tokenized funds? Is this something that you hear about from the perspective of just structuring of the fund?
So it's a good question. So our LPs, right? So we're a very classic hedge fund. So we have a bunch of family offices, fund of funds, and for the most part, those investors don't care, right? They don't care if they're not buying a tokenized fund.
Right.
I think the ones who do care are crypto capital. So people who have crypto capital. And so this could be large whales, it could be people, high net worth individuals who are looking for, I think, higher yield than what you would normally get. They're like, oh, hey, why don't you tokenize your fund? Right? Why don't you create a version of Monarq on chain? And so we've started to get a lot of those requests. We haven't acted on it yet. So today we don't have a tokenized.
So it's still early.
Yeah, it's still early in my opinion. Yeah.
Okay. Well, because I want to be a fair moderator, Kevin, I'll let you then take your perspective on that.
We love tokenized funds. Tokenize more funds so that we can access them, and let us know if you're tokenizing a fund. We'd love to chat.
I think this is actually one of the interesting discrepancies that people, or maybe emergent effects that people weren't expecting, which is that everybody was expecting to build tokenized funds, and then for traditional financial asset managers, allocators to be the buyer, because you get things like, liquidity and T+0 settlement and all of the great things that we talked about. And I think this is one thing that we slowly realized over time at Galaxy, starting in 2021 and 2022, where we really were focused on serving the traditional financial external capital. Right. And then all of a sudden, you look up one day and there's massive buyers, allocators on chain like Maker and Spark and Grove, who actually, there's crypto native capital then allocating to these strategies on chain, and they want to access it on chain because they want to access all the ways it's tied in with the rest of the ecosystem. And so one of the surprising, I think realizations has been the emergence of the crypto native capital allocator, who is then the buyer of some of the tokenized hedge funds, which may actually look more like traditional structures and traditional funds. And I don't think Apollo's selling ACRED to access the buyers that are already on their LP roster. It's to access a new set of buyers, which is emergent and may not be 50% of their fund LP roster, but it could be 1 to 5%, right?
And think about where things are going now, right? If there's a lot of changes happening to like the 401k space, right? That might be a good option for these 401k providers to have a tokenized asset as opposed to having a private asset, which is kind of the gray area everyone's trying to sell right now. With that, we were actually over time. I want to thank the panel today. It was a great conversation. Again, as I said, hedge funds are getting into the space. And for the record, I got Will to make an announcement too about Galaxy tokenizing the security.
That was a week ago.
Thank you, everybody.
Thanks.